Hello everyone and welcome to our Toronto Centre webinar. I'm Jerry Lewis and I'll be your host for today's session. Thanks very much for joining us. Our topic today is climate risk and its implications for financial stability. Our session will be approximately 30 minutes, and after the event, an archived version can be found on the Toronto Centre website. Questions and comments may be posted at any time during the session using the chat function on your screen. We'll respond to all questions via email. Finally, to improve our webinars and to learn about topics you're interested in, a brief survey will be sent to you after this session. Your feedback is very important to us, and we hope you take a moment to complete it. To begin with, I'm here with Babak Abazadeh, CEO and President, Toronto Centre. Welcome, Babak.
Thank you, Jerry. Good to be here.
Now, Toronto Centre is well known for its classroom programs on financial sector supervision around the world. This is our very first Toronto Centre webinar, and I understand you plan on doing more. Why this topic?
The idea came about as a result of our two successful executive panel discussions covering the twin topics of climate change and financial stability, as well as green finance, which we held at the IMF World Bank semi-annual meetings in April and October 2016 in Washington. Other important international fora are also looking at related issues. For example, the Financial Stability Board is looking at climate risk-related financial disclosure. Also this year, during their G20 presidency, China commissioned a synthesis report on green finance. We want to continue to make a contribution to this global conversation by helping financial sector supervisors and regulators understand the implications and challenges and opportunities. In today's webinar, we will explore the two global policy preoccupations of climate change and financial stability together, which is not done commonly. In doing so, we're hoping to advance the conversation around what regulators and supervisors need to do in order to facilitate policy instruments and responses, and also to protect financial systems, investors, and the general public against climate-related risks. This is important to us because Toronto Centre's mission is to promote change that would lead to sound, stable, and inclusive financial systems that in turn will foster clean economic growth and poverty reduction. Because of this, we think the discussion on climate risk and implications for financial stability is a critical topic. We hope to host more of these sessions in 2017 to meet the needs of our TC community.
Thank you very much, Babak. Our first presenter today is Stefan Ingves. He is the Governor of the Central Bank of Sweden and Chair of the Basel Committee on Banking Supervision. Thanks for joining us on this webinar, Stefan.
Thank you. Let me make a few general remarks and then provide a few comments about the relationship between financial stability, Prudential Regulation, climate change, and the risks that go with climate change. In the last decade or so, the evidence has become ever clearer that climate change is real and it's a growing issue. Global climate change affects communities all over the world, and there will be opportunities as well as risks associated with climate change. But all in all, I think that the balance is such that we're really talking about something negative as global average surface temperatures become increasingly warmer and warmer over time. Because of this, climate change has been receiving increasing critical attention in international fora. So in April 2015, the G20 finance ministers and central bank governors requested the Financial Stability Board, the FSB, to convene representatives of the public and private sectors to think about how the financial sector can take account of climate-related issues. Last September, the FSB chair, Governor Mark Carney, underscored the importance of climate change for financial stability and explained in his speech how shifts in the climate can have profound implications for insurers, financial transparency, and also ultimately for the real economy. He urged that early action could be needed to mitigate the need for more costly adjustments later. Also, in December 2015, the FSB launched the industry-led task force on climate-related financial disclosure to develop a set of recommendations for consistent, comparable, reliable, clear, and efficient climate-related disclosures by companies. Then this year, China announced that climate change and development of green finance will be a key agenda item during its 2016 G20 presidency. Now, climate change is a global problem, and solving it would prove very difficult if solely left to individual countries. And this is because the benefits of cutting emissions are global, while the costs of doing so are mostly borne nationally. So for this reason, the Paris Agreement on climate change is considered a historic diplomatic achievement to get to this point. Now, climate change has also become one of the major priorities of governments, and the key objectives of the UN 2030 Agenda for Sustainable Development are providing assistance to countries that are vulnerable to the destabilization effects of climate change. The potential risks of climate change to the financial sector and financial stability are complex, to say the least, and understanding these risks is at a very early stage. The Financial Stability Board identified 3 climate change-related risks. First one is physical risk. This first-order risk, which arise from weather-related events, here we talk about such things as floods and storms, their impacts that result directly from events such as damage to property, and those that may arise indirectly through subsequent events such as disruption of global supply chains and resource scarcity of various kinds. Second risk is liability risks. These are risks that could arise for insurance firms from parties who have suffered losses and damage from climate change, and then in turn, insurance companies might sue for damages trying to find somebody responsible, and this is likely to produce potentially long chains of third-party liability issues, such as professional indemnity or directors and offices of insurance. Complicated and difficult to deal with. Then we have transition risks. Now, these are financial risks which would result from the process of adjustment towards a lower carbon economy. Here we're talking about changes in policy, changes in technology, and physical risks that could prompt a reassessment of the value of a large range of assets as costs and opportunities become apparent and costs and opportunities change over time. Now, the abruptness with which such repricing occurs could, of course, influence in one way or the other financial stability. It is quite likely that all of these risks will grow over time as the impact of climate change increases. Now, here, access to better quality information will allow market participants to understand and manage these risks better. More importantly, better information could reduce the dangers to financial stability of abrupt shifts. In this regard, financial reporting standards could play a critical function in the world economy by providing information to investors that inform capital allocation decisions. Now, these standards help to minimize risk and speculation by giving investors a better understanding of an asset's underlying fundamentals. And climate change is a risk that existing reporting standards have yet to adequately measure. A climate change risk disclosure regime is emerging, defined by a range of voluntary, regulatory, and accounting governance initiatives. And by doing so, it will become clearer over time to what extent in individual company cases climate change matters a lot or not so much. Now, the goal of climate change financial risk disclosure is twofold. First, disclosure improves financial stability by providing information on potential risks generated by investment in areas of the economy exposed to climate change. Second, disclosure improves environmental accountability by generating information that investors can use to align their own portfolios with firms seeking to reduce their contribution or their exposure to climate change. Now, as part of its work, the task force that I just mentioned conducts a large number of public outreach events to engage a wide and varied range of stakeholders. Also, a G20 Green Finance Study Group was set up in January 2016, co-chaired by China and the UK, in order to identify institutional and market barriers to green finance and to analyze options on how to better mobilize private green investments. Now, with regard to greening the banking system, the study group has reviewed the market and institutional failures that may impede banks from incorporating environmental dimensions into decision-making of various kinds. Emerging from GFSG work are a number of options for the G20 and country authorities for consideration for voluntary adoption in order to enhance the ability of the financial system to mobilize private capital for green investments. Also, global climate change poses significant risks to macro financial stability. Financial and non-financial corporate sectors face risk from climate damages and stranded assets, for example, such as coal reserves that become uneconomic with carbon pricing. This type of disruption could affect corporate balance sheet quality, and some financial regulators and central banks have started thinking about systemic risks related to climate change. But I also think it's fair to say that this work is in its early stages and more action is needed over time at the national level to monitor and address these types of risks. Here, the financial system can play a key role by supporting reductions in climate change risk and mitigating the impact of adverse climate events. Long-term institutional investors can help with rebalancing and redistributing of climate-related risks and maintaining financial stability. Hedging instruments of various kinds can help insure against increasing natural disaster risks, and other financial instruments can help reallocate investments to green sectors. Financial sector supervisors and regulators can, in this field, play an important role in addressing risks and developmental opportunities for the global financial system posed by climate change, and possible government and private sector responses. Financial sector regulation and supervision can support green market development and protect financial stability by considering whether climate change-related risks are being adequately addressed in regulation and supervision, while at the same time taking a proportionate approach to avoid compromising customers' access to affordable finance and insurance. Now then, what about prudential regulation in this context? We have been hearing sometimes about proposals to adapt capital risk weights, liquidity standards, and other prudential regulations to provide incentives for low-carbon investments. But altering financial regulations may not be the best way to address climate risks. The focus of financial regulations should remain on building resilience to shocks, with a systemic approach accounting for all material risks to the financial system, including from climate events, and also to ensure adequate capitalization, risk management, and disclosure. Here, instead, I would point towards policies to assist the markets itself to transition to a low-carbon economy. And I think a natural starting point would be to enhance the disclosure of information related to risk from climate change. This would allow all stakeholders, including banks, to better assess the costs and the opportunities created by climate change. From a supervisory and regulatory point of view, the natural way to think about this is in terms of risk. While I don't think this is something that regulators should prescribe, it is certainly something that we should encourage banks to think about. The issues are complex, and there is, I think, a lot of uncertainty associated with making these types of assessments. So let me here give you a very simple example. And I have to be careful here because this is a hypothetical example. Let's say a bank has exposure to two automakers and wants to make an assessment of the environmental risks as part of its broader assessment of risk of these two counterparties. Let's now assume that there are two automakers, and those two automakers are Tesla and Volkswagen. I think environmental risk is central to assessing the relative risk of the two exposures. But these risks pose environmental risk in very, very different ways. In the case of Volkswagen, clearly the recent emission scandal is a situation that any lender would consider serious. Accordingly, lenders might ask, does the same risk apply to the other automaker? This is not implying that it does, but from a risk perspective, it is quite natural to ask this question. In the case of Tesla, the risks are very different nature. They relate not so much to issues of emissions, but rather to the uncertainty over the future of electric cars, in particular around potential competitors and the mass production of this type of product. So this is just an example. But I do think it illustrates that the issue of environmental risk is central to many credit decisions. Now, let me conclude. We know that climate change is a growing global problem, and it requires global action. It affects all of us, regardless of development level of our economies. Climate change poses risks to global financial stability as well, but those risks are very complex. Now, in order to be able to solve this problem, first we need to understand the risks well, and then we need to develop options. In this regard, the recent developments in the agreement in Paris and the FSB Task Force on Climate-Related Risk Disclosure and the G20 Green Finance Study Group in the international arena are all very encouraging, and I hope that they will help us to understand these issues better so that we can make improvements in the future. Thank you.
Thank you very much, Stefan. And our next presenter today is Adele Morris, Senior Fellow and Policy Director for Climate and Energy Economics at the Brookings Institution. Welcome, Adele, and thanks for joining us today.
Well, thanks, Jerry. It's a pleasure to join you. I'm pleased to be with you today to talk about climate-related risk, particularly disclosure and the issues around financial stability. As an economist, I think about climate change as a market failure. So when I put gasoline in my car, the price I pay doesn't reflect the damages to the environment that come from the use of that gasoline. So we call that damage and externality, and there are a whole number of concerning outcomes of disrupting the Earth's climate. Accordingly, economists advise imposing an economy-wide price on those greenhouse gases, especially carbon dioxide, as a central policy strategy. But right now, most climate policies around the world are still under construction, to say the least. We have some commitments under the Paris Accord, but countries really haven't announced exactly how they're going to achieve those commitments. And there are a host of other policies that also need to be developed, including how to adapt to a changing climate and a bunch of other things listed here. And part and parcel of that is what should be the role of financial regulators in requiring disclosure and preventing any kind of financial instability that results from the disruption of climate or the policies that can reduce those risks. So as you heard from Stefan, there are three categories of risks that we talk about. The actual damages from climatic disruption, and I want to add ocean acidification to that, which is when the pH of the ocean changes as a result of absorbing CO2. That can have important ecosystem effects. There's the litigation risks of who's going to sue whom for what and whether or not they can win, and the transition issues. I don't generally call those risks because a lot of that has to do with uncertainty over what the policies to reduce greenhouse gas emissions are going to be. And once those policies are set, we know what some of the outcomes are going to be and what that means for different firms and their businesses. So I wouldn't put it in the same category as some of these other risky outcomes. So let's start with the risk of climatic disruption. What we're talking about there are the kinds of operations that companies have that are going to be vulnerable, for example, to increasing storm surges if they're in low-lying coastal areas, or if their businesses are vulnerable to things like droughts and floods. For example, if you run a brewery, You need a reliable supply of clean drinking water. And if you don't have that, you just simply don't have the inputs to your production. And that's a real risk. In addition, you might need other inputs such as timber or fish to do your business. And if those resources are disrupted, you're going to have a tough time. And there might also be disruption to the labor supply if, for example, where you operate becomes vulnerable to malaria or the Zika virus, and that disturbs your workforce. Just to give you a few concrete examples, the first picture there is the Dominican Republic coast, which was an important tourist area that became choked with rotting seaweed, and that really impaired the tourist industry there. That was just last year. The picture to the bottom left is a hydroelectric dam, and actually hydropower is quite vulnerable to whether or not there's sufficient rainfall to keep the reservoirs full. And the picture on the bottom right is an apartment complex in Siberia that was built on permafrost. So when the permafrost began to melt, it damaged the foundation of the building. So there's three widely different risks associated with climatic disruption, and that's the kind of range of things we might see. So how would we ask firms to disclose these risks? Well, it's hard to do anything that's standardized because these risks are so diverse, so disparate. They depend very much on a firm's particulars and where it operates. But one might be able to find ways to create maps or indices of risks. There's a picture of the Florida coastline that would be eliminated if there's a 1 meter rise in sea level according to some of the models. And those kinds of tools might help investors know how to assess the risks in certain areas. Another consideration, of course, is what happens if investment does go away from vulnerable areas. I think there's a concern, for example, if suddenly investors decide, well, we don't want to invest in the Dominican Republic. Well, what does that mean for that country and its economic base? The litigation risk is quite different, and that is very hard to predict. I think in the United States, it's uncertain how much liability firms are actually going to face, but so far they seem to come in at least 4 buckets that I can tell. One is this whole concern that companies have misled shareholders and the public about climate change science. And so there's some concern that maybe ExxonMobil knew about the risks of climatic disruption from greenhouse gases and otherwise in either obfuscated or mischaracterized that science. And there are some legal proceedings associated with that. There's another different concern that suggests that companies are overpricing their fossil fuel assets, because if you look at the climate goals, there's a clear indication that not all the fossil fuels that are on the books of companies can be burned if we're to meet certain stabilization goals of the Earth's atmosphere. The problem is there's no policies right now that prevents the burning of that carbon. So the question arises, is it reasonable to expect firms to behave as though there are policies that don't really exist yet, just because the science indicates those policies might be warranted? There's also a concern that insurers might be able to sue emitters to cover their losses. I guess the question is, who are the emitters? Are they the fossil fuel companies or the likes of me who put gasoline in our cars? So I'm not sure how that really would work. But we do know that firms should be taking actions to avoid damages from climatic disruption, and it does make sense to anticipate some kind of climate policy, and there could be liabilities associated with failing to take those actions. One important note is that the legal risk can vary widely across countries, but even within countries, as state-level policies for these kinds of liabilities might be quite different than at the federal level. So now let's move on to the transition issues. So right now, we don't know really what the policy environment is going to be, and I'll just use the United States as an example. Right now, we have a regulatory system that's under the Clean Air Act, which really wasn't designed for greenhouse gases. And we're seeing a protracted process of promulgation of regulations. The president has been working to impose the Clean Power Plan, which restricts emissions from U.S. power plants. We don't know how those regulations will play out. It depends on who's in the White House and what actions they take and what the courts uphold. It's hard for companies to know what their future is under that scenario. But even if we had an alternative policy scenario, such as a clear and predictable carbon tax, we don't know now what that would look like. And the individual impacts on firms are going to greatly depend on the exact particulars of that policy. Just for an example, if you impose a carbon tax, but you use the revenue to reduce corporate income tax rates, that could be very different for firms than using the revenue for transfers to households. So it's really not clear what transitions we're talking about. And indeed, any one policy could be quite vulnerable to a change of administration or Congress that reverses the policy direction. And even across the world, we don't know what transition we're talking about. These 4 lines represent very different emissions pathways that result in very different climatic futures. And so companies don't know which path we're going to be on. And I guess for financial regulators, you might say, well, we've got the Paris Accord. Well, that only goes out to 2025, 2030 timeframe, and many of these investments are very long lived, so it's hard to know what to make of all that. And in addition to the fact that the policies haven't been implemented at the national level. And just to take an example, even if we go forward with all of the policies that President Obama has instigated and the next administration follows through on all that, we still have a number of additional measures that are unspecified that will be required for the U.S. to achieve its commitment. We don't know what the economic outcomes of that. So one thing we could do for disclosure is to offer some standardized policy scenarios for firms to consider when they play out the risks associated with the adoption of climate policies. But it's kind of complicated because, like I said, it depends on the particulars of the policies, but it's not just about the company's own carbon footprint. I could be a very energy efficient railroad operator, but if all I haul is coal, I'm going to be extremely vulnerable to the outcomes of the policies. And it depends on how any one firm is situated relative to its competitors, what happens with policies in other countries that affect my market and my ability to pass along my costs to the buyers of my products and so on. There are some ways we could standardize these policy scenarios, and I'll give you an example. And there are some regularities in the outcomes in this literature. One thing we know is that if there's anything like a carbon price or carbon regulation that's cost effective at all, it really does disproportionately reduce the demand for coal. And this is a simulation done by the U.S. Energy Information Administration in 2014 of a tax on carbon in the electricity sector. And that bottom wedge is showing the use of coal in electricity. And you can see that that tax scenario where it starts at $25 and goes up at a rate above inflation just basically eliminates the major market for coal in the United States. So those things we can kind of know, but a lot of things are harder to predict. So let's talk about disclosure related to transition. We already have standard methods for measuring greenhouse gas emissions at a firm level. What we could use is some more methods to allow firms to show that they've adequately considered a carbon price future. That's called shadow pricing. And we could allow for these policy scenarios to be standardized and allow companies to stress test accordingly. We also want to account for the fact that there might be weak climate policies, and there may be the chance that clean energy subsidies and mandates are eliminated and that really there doesn't end up being much of a market for some of these clean energy technologies. And that certainly is a downside risk for those firms. So The issue of disclosure raises as many questions as it might answer, and this is a kind of a laundry list of what might arise for authorities who are considering disclosure measures. I'm not going to go through them, but the point being is I think we're still in early days about how to assess the net benefits of disclosure policies and what should really go into them. So I'm going to shift to financial stability real quick and say my view is maybe a little bit different than Stefan's. If we want to think about, well, what's really going to threaten the stability of financial markets, it may be the case that climatic disruption can exacerbate natural disasters, but insurance reprices regularly, and premiums can go up to reflect rising costs and risks of these events. So I don't necessarily see a financial instability risk too much in the insurance market as long as repricing can happen. What might happen is an abrupt policy change, but the thing is I don't think policymakers are going to be willing to undertake really abrupt policy changes that strand capital and risk the financial stability of their economy. So I don't see a huge risk there unless policymakers are completely irresponsible. There may be other things that affect financial stability, such as big swings in commodity prices or asset values related to them. But we've already seen gigantic swings, and most recently in oil prices, and it so far hasn't really resulted in financial instability, maybe for some banks who are very concentrated in those industries. But I don't see something that's really widespread, at least as of yet. There might be other things like technology or changes in consumer sentiment. But I guess I would just ask, if we are worried about financial instability, let us scan and be a little critical in our eye of exactly where we think those shocks are going to come from. Where I do see weak spots certainly are in areas that are very coal reliant. And that could appear in the municipal bond markets or subfederal bond markets of jurisdictions that are extremely dependent on fossil fuel extraction for their revenue and their economic base. And one example is certain counties in southern West Virginia where simultaneously they're losing a lot of their coal severance tax revenue, which is a big source of income. At the same time, they're losing all the jobs from the closing coal mines. And that is really a double whammy for those areas and might show up as a risk in bond markets of that sort. So what can financial market regulators do? I think the most important thing is to emphasize the value in developing well-designed climate policy, have that policy be efficient, predictable, transparent, and market-oriented, and do everything they can to call on the leadership of the finance ministers and those who with the appropriate economic expertise to ensure those policies really make sense. Well, thank you very much, Jerry, for the opportunity to talk with your folks. And I just wanted to say if anybody has an inexplicable interest in understanding more about the economics of climate policy, I've offered up a few slides at the end of this presentation of other things that I've written that they might find of interest.
Thank you, Adele. In fact, thank you to both our speakers today, Stefan Ingves and Adele Morris. And thank you and everyone joining us here today. We hope you found our webinar informative and relevant. Questions submitted during this session will be responded to you by email. Shortly, a survey will also be sent to you to let us know how we did and how we can improve for future webinars as well. An archived copy of this webinar will be available at the Toronto Centre website, and more information will be coming to you. We look forward to receiving your feedback. Thank you, and goodbye for now, everyone.